Welcome to the Morrows half-yearly update. This update highlights the key messages that we would like you to take from the detailed written investment report that we've recently prepared for you. Today we'll take a look back at what happened in 2018, have a look at where we are in the economic cycle heading into 2019, and provide an overview of our portfolio strategy and asset class positioning. The global economy started 2018 in a very buoyant mood with sentiment indicators at 30-year highs. Everything was going right for markets until the 3rd of October 2018, when the US Fed chairman said that interest rates were a long way from being either stimulative or restrictive. After this comment, US share markets fell by 20% during the December quarter, only to recover some of those losses in the last week of the year. The S&P 500 index fell 14% for its worst quarterly return since 2011, and the Nasdaq fell 18% for its worst quarterly return since 2008. This chart shows that 2017 was a very strong year, with only 1% of all US dollar assets having a negative return. Effectively, everything made money. In 2018, we saw a complete reversal, with 90% of all US dollar assets having a negative return. Effectively, nothing worked last year. 2018 played havoc for both passive and active strategies, and will be remembered as the worst year for broad US dollar asset returns in the last 117 years. Our diversified income funds provided positive returns of 2 to 3% last year. We didn't have exposure to investment grade or high yield credit, which was a positive decision given that these assets posted negative returns for the year. For Australian shares, we had 2 of our funds generate positive returns, but overall we were disappointed with this asset class given the absolute return focus of many of our underlying strategies and their track record of protecting downside in adverse market environments. As a result, we're currently reviewing each of these strategies. For international shares, 3 out of 4 of our global managers provided positive returns, with our private markets fund generating double-digit returns. Global equity market neutral was disappointing, and we've currently got this fund on review. From an overall portfolio perspective, our decision to have very low market beta was the right one in 2018. However, our absolute return alpha generating strategies found it very difficult to deliver in what was a tough and challenging environment in 2018. The 2018 year was highly unusual in our view, with only 16 out of 450 global hedge funds monitored by HSBC able to deliver a positive return. There are a range of factors that may be attributed to why absolute return and hedge funds had a poor year in 2018, and I'll briefly touch on a few of these. As more money flows into passive strategies, the larger and more expensive stocks get bought up. Fundamental value is ignored and momentum continues to propel these stocks higher. We question whether this is the new normal or whether it is subject to reversal, particularly during the next market downturn. Growth has outperformed value as an investment style since 2008, a trend that has accelerated over the last 2 years. How long can this continue before we see a reversal out of growth and into value? This chart shows profitable companies outperformed unprofitable companies in the US from 2010 to 2015, which supports a rational and fundamentally driven market. But we know that markets can be irrational, and there are times when companies with weaker fundamentals outperform, which is what has happened from 2016 to 2018 in the US, particularly in 2018. This environment is not suited to most long-short equity strategies. The key question is, how long can these market dynamics persist for? History suggests that 2018 was an abnormal year, and accordingly we do not want to overreact to it. That said, we need to review each of our underlying investment strategies to ensure that they can achieve their return objectives and are suitable for the current economic cycle. That brings us to the question of where are we in the economic cycle? This is an important question because the phase of the economic cycle can assist us in making asset allocation decisions that will impact future investment returns. In our previous half-yearly update, we indicated that the cycle was mature and in late upswing phase, but since then we have seen various data points move towards economy's slowing phase. From a cycle perspective, the US Fed is tightening liquidity via its balance sheet and higher interest rates, noting that it has paused for now. Global economic growth is slowing, manufacturing looks to have peaked and corporate earnings are slowing. Growth assets have fallen from their highs and may have topped out, and inflation may have also peaked. The consensus view is that the US will not be in a recession this year, with probabilities rising into 2020 and 21. Based on that view, markets can continue to move higher, but we note that markets are forward-looking and historically peak well before a recession actually happens. Given this environment, investors face a tough challenge or choice. They can either accept the market's warning signs of an impending downturn and position defensively, or they can defy the market and accept risk amid cheaper valuations, although those valuations are not so cheap anymore. These two charts show that US equity markets are very expensive relative to history, and this does not bode well for future returns. The harsh reality is that the phase of the market cycle and current market valuations mean that it's almost certain that future investment returns are going to be lower. Let's explore this further. The left chart shows that interest rates and yields have fallen for the last 3 decades and are currently at a record low, maybe heading even lower. Lower interest rates equals lower returns on the defensive part of your portfolio. This means that the growth part of your portfolio needs to work even harder to generate returns. But growth assets such as shares and property are already historically expensive. In our view, this means that future portfolio returns are going to be lower. This view is also shared by many others, including BCA Research, who have forecast returns from a traditional US balanced portfolio to be around 3.3% per annum for the next 10 years. This is shown in the table on the right. Others, such as Franklin Templeton, Vanguard, MFS and JP Morgan, have similar 10-year return forecasts in the 3 to 5.5% per annum range. Investors need to rethink their overall approach to portfolio construction and start thinking in terms of risk diversification and trying to get as much exposure to different and non-correlated types of risks. This requires building portfolios around risk diversification rather than just traditional asset class diversification. MPW recommends that you adopt a combination of options 3 and 6 for the following reasons. Option 1 is unrealistic given high starting valuations mean that future returns are likely to be lower. Option 2 is not desirable as traditional diversified portfolios are unlikely to meet your return objectives. Option 4 guarantees a return between 2 to 3% per annum and requires you to time the market. And Option 5 will work up until it doesn't. Then your capital is exposed to significant downside risk. Option 3 suggests reducing risk and accepting lower returns. But if you combine this with Option 6 and invest your cash into special niches such as alternative assets and absolute return strategies, then you can reduce market risk, but not necessarily have to accept lower returns over the cycle. Lastly, I'll discuss how portfolios should be positioned based on our views of the current economic cycle and asset class valuations. We have been holding low levels of cash given low returns and a view that we are still in the late upswing phase of the cycle. We envisage increasing cash throughout 2019 as the cycle moves into economy slows phase. Our currency exposure is neutral, but we envisage moving this more towards unhedged to benefit from a fall in Australian dollar. We have avoided government bonds in recent years as yields were rising during the late upswing phase. But with the synchronised global growth story now changing to a synchronised global deceleration story, we will increase high-grade government bond exposure in the coming months. Credit market risk is high given historically low spreads, high leverage and lower credit quality. We are underweight to credit and need to see spreads widen quite a lot before we would reallocate to this sector. We have some exposure to listed property securities via our long-short equity funds, but do not want a direct holding in this asset class given the late cycle phase and how these securities correlate with shares in risk-off markets. We don't have any exposure to Australian long-only beta strategies given market valuations and the lack of downside risk protection. We prefer global shares to Australian shares given currency benefits from a fall in Australian dollar. We have an overweight exposure to Australian equity absolute return strategies given their lower correlation to the Australian share market. We are reviewing these exposures given the disappointing returns during the December quarter market sell-off, and we expect to make some fund changes in the coming months. We don't have any exposure to global equity long-only beta strategies given market valuations and the lack of downside risk protection. We prefer global shares to be unhedged and benefit from a fall in Australian dollar. We have an overweight exposure to global absolute return strategies given their lower correlation to broader share markets. We are reviewing our market neutral exposure given the relatively poor performance in 2018. Liquid alternative assets such as managed futures will be retained given their low correlation with traditional asset classes, and global macro and relative value strategies will be reviewed opportunistically. Private equity will be retained given its low correlation to listed markets and ability to provide solid returns should markets continue rising, but also minimise drawdowns should markets fall. Illiquid alternative assets such as private equity, private debt, infrastructure and direct property will be reviewed opportunistically. Investors must be prepared to lock up capital to access these strategies, but in our view, there is generally an illiquidity premium to justify the lockup. We acknowledge that the 2018 year was a tough year for many of our underlying investment strategies. We've reviewed these in detail, and whilst we envisage making some changes in the coming months, we still maintain a very high conviction in the overall portfolio strategy, particularly given where we are in the economic cycle and current market valuations. Pleasingly, many of the strategies that did have a tough 2018 have rebounded strongly so far this year and are performing in line with our expectations. We hope that you've found this update informative, and we thank you for taking the time to listen in. Please listen to this update in conjunction with your detailed written investment report that we've prepared for you, and contact your advisor if you would like to discuss your portfolio in more detail. Thank you.